You don't need to pray to God anymore when there are storms in the sky, but you do have to be insured. This is one of the famous quote by a German poet during the period 1898 to 1956. This shows the literal importance of insurance. Welcome all to the third part of Unit 1. In the previous discussion, we discussed on the meaning of insurance, definition of insurance, features of insurance and functions of insurance in a detailed manner. Now, we are going to see in this session about the evolution of insurance, kinds of insurance, principles of insurance and importance of insurance. Let us start with origin and evolution of insurance. The earliest traces of insurance in the ancient world are found in the form of marine trade loans or carriers contracts, which included an element of insurance. Evidence is on record that arrangements embedding the idea of insurance were made in Babylonia and India at quite an early period. In Rig Veda, the most scared book of India, references were made to the concept Yogakshama, more or less akin to the well-being and security of the people. The codes of Hammurabi and Manu had recognized the advisability of provision for sharing the future losses. However, there is no evidence that insurance in its present form was practiced prior to the 12th century. First, we look into the origin of marine insurance. Travelers by sea and land were very much exposed to the open seas and land were very much exposed to the risk of losing their vessels and merchandise, because the piracy on the open seas and highway robbery of caravans were very common. Then origin of fire insurance is, after marine insurance, fire insurance developed in present form. It had been originated in Germany in the beginning of 16th century. The fire insurance got momentum in England after the Great Fire in 1666, when the fire losses were tremendous. Now, we see the origin of life insurance, which is the most important division of insurance industry. A life insurance in its modern form is a Western concept. The origin of insurance took place in England in 16th century with the insurance of the first life insurance policy. In those days, the companies that followed mainly catered to Europeans and charged extra premiums on Indian lives. Then, origin of miscellaneous insurance. The miscellaneous insurance took the present shape at the later part of 19th century with the Industrial Revolution in England. Accident insurance, fidelity insurance, liability insurance and theft insurance were the important form of insurance at that time. Lloyd's Association was the main functioning institution. Now, insurance such as cattle insurance, crop insurance, profit insurance, etc. are taking place. The scope of general insurance is increasing with the advancement of the society. I think you are all very clear in origin and evolution of insurance. Shall we move to the next aspect, kinds of insurance? Broadly speaking, there are two main branches of insurance in our country, that is life insurance and general insurance. The general insurance is subdivided into three types, namely fire insurance, marine insurance and miscellaneous insurance. At first, we see life insurance. It refers to a contract in which the insurer agrees to pay a specified amount on the death of the assured or on the expiry of a certain fixed period which is earlier. In consideration of this, the insurer collects a premium from the insured. Since the sum for which a policy is taken is assured to be paid whether there is death or not, life insurance business is also often referred to as life assurance. The next kind of insurance is non-life insurance, or it is called general insurance. Except life insurance, all other insurances come under general insurance. The tangible assets are susceptible to damages and a need to protect the economic value of the asset is needed. For this purpose, general insurance products are brought as they provide protection against unforeseeable contingencies like damage and loss of the asset. Like life insurance, general insurance products come at a price in the form of premium, but the claim is payable only when the risk is occurred. So, the term assurance is not suitable for general insurance. Let us discuss on the differences between the insurance and general insurance. Life insurance is loss due to risk is certain to happen, but risk of death is bound to happen sooner or later. Non-life insurance is, in case of general insurance, loss due to risk is not certain to happen, loss that is likely to happen or not. Life insurance is, human life is the subject matter of life insurance contract. In non-life insurance, generally goods or property of any other kind are the subject matter of non-life insurance. In life insurance, in case of life insurance contract, the contract is a continuing contract, that is long term contract. But in case of general insurance, insurance contract is usually for only 1 year. In life insurance, it is not a contract of indemnity. In non-life insurance, fire, marine insurance and other contracts are contracts of indemnity. In life insurance, insurable interest must be present only at the time of taking out the policy, but need not have insurable interest at the time of maturity of the policy. But in non-life insurance, in fire insurance, insurable interest must be approved both at the time of policy is affected and at the time when loss occurred. In marine insurance, it must be present only at the time of loss occurring. It is not necessary at the time of effecting the policy. In life insurance, the term assurance is referred only to life insurance business, but in non-life insurance, the term insurance is used to other kinds of non-life insurance contracts. In life insurance, in life the insurance policy can be surrendered by the assured before its maturity, but in non-life insurance, in case of marine and fire insurance, the policy cannot be surrendered by the assured before its maturity. In life insurance contains both the elements, that is protection and savings, but in case of non-life insurance, the case of fire and marine insurance, insurance contain only the protection elements. In insurance, the most important criteria is principles of insurance, because the functioning of insurance is based on the principles alone. Now, we are going to discuss on the principles of insurance. We know very well that insurance is a contract. It based on certain fundamental principles. These principles are common to all types of insurance such as life, fire, marine and miscellaneous insurance contracts, with the exception of the principles of indemnity, which is not applicable in the case of life insurance contract because of it being a contingent contract. These principles are: We will see one by one. Cooperation, probability, utmost good faith, insurable interest, indemnity, contribution, subrogation, causa proxima, warranty and mitigation. Students, you know what is principle of cooperation? The insurer collects premium from the insureds in a pool and pays their claims out of the pool. The insurer is an association of persons who pays the claims out of its pooled money, that is sharing the loss of few by many. Thus, insurance is based on the principle of cooperation. Next, we will see what is principle of probability. The occurrence of risk in each type of insurance is estimated through the theory of probability, for which the insurer follows the theory of large numbers. The insurer's collection the data of previous happenings taking a large number of years into consideration and forms an idea about the incidents in future. What is principle of utmost good faith or ubrima fide? In case of insurance contract, let the buyer beware does not prevail, because insurance is based upon mutual trust and confidence between the insurer and insured. Ubrima fide in Latin or utmost good faith requires each party to tell the other the truth, the whole truth and nothing but the truth. It means that the parties to the contract must make a full disclosure of all the material facts and information relating to the contract. Then, what is principle of insurable interest? For an insurance contract to be valid, the insured should have an insurable interest in the subject matter of insurance. The insurable interest is pecuniary interest, whereby the insured is benefited by the existence of the subject matter. The subject matter of insurance may be a property or life or legal liability. The time when insurable interest should exist differs according to the nature of insurance. In life insurance, the assured should have insurable interest at the time of contract was entered into. In marine insurance, it should be present at the time of loss, but in fire insurance, insurable interest should be present not only at the time of taking a fire policy, but also at the time of loss. Then, what is principle of indemnity? The term indemnity means making up the loss, that is compensation. Literally, it means security against damage or loss or compensation for loss. All contracts of insurance except life and personal accident and sickness insurance are contracts of indemnity. According to the principle, the insured should be placed in the same financial position as far as possible after a loss as he occupied immediately before its occurrence. Then, what is principle of contribution? Contribution is also a corollary to the principle of indemnity. This principle applies where there is more than the same period and for the same insured. In such cases, the insured can make claims under all policies with different insurers and recover pro rata from each. What is principle of subrogation? This principle is just a corollary of or supplement to the principle of indemnity. Subrogation means inheriting the rights available to an individual. The insurer, after making good the loss, is entitled to all the rights of the insured against third party as regards the subject matter of insurance. Subject matter is nothing but the property under insurance coverage. Then we will see what is principle of causa proxima. The maxim causa proxima non remota spectator means that proximate, that is nearest cause and not the remote one, is to be taken note of at the time of determining the liability of the insurer. The insurer is not liable for remote cause even if it is one of the insured perils. Therefore, if the immediate cause is an insured risk for the occurrence of which the insured is to be paid, the insurer is liable to make the payment of loss under the policy, otherwise not. What is principle of warranty? There are certain conditions and promises in the insurance contract which are called warranties. Then what is principle of mitigation of loss? This principle emphasizes the duty of the insured to take all possible steps to minimize the loss or damage to the property covered by the insurance policy. This principle aims at making sure that the insured behaves as a prudent person and does not become careless after taking a policy to cover any risk. Students, do you know that insurance is one of the supporting pillars of the Indian economy? Let us discuss the importance of insurance. Insurance is very important for modern age. In present day, life is very complex and our needs are no longer restricted to psychology needs alone. Man, his family and their belongings and properties are always exposed to a variety of risks. He also needs enough money to finance present necessities of life as well as a portion to provide future necessities of life for his dependents and also for his business if something untoward happens. The importance of insurance may be studied under 4 heads. They are: number 1 is importance to an individual, number 2 is importance to special group of individual, that is we may name it as business. Number 3 is importance to commerce and industry. Number 4 is importance to the society as a whole. We will see one by one. Importance to an individual. Insurance provides security and safety. It ensures financial protection against large and uncertain losses to the lives and properties in consideration of a small amount of premium. In case of life insurance, payment is made when death occurs or the term of insurance policy expires. In case of personal accident and sickness, financial protection is given when the individual is unable to earn. It provides peace of mind. Every person faces the risk of living too long or living too short or disability caused by accident or by sickness leading to loss of income. A sense of security against these losses removes all tensions and fears. Insurance, by providing financial protection and promise to compensate losses, stimulates more and better work performance of an individual. It eliminates dependency. In the event of death of a breadwinner of the family or disability of work due to involvement in any fatal accident or sickness, the family of an insured is affected. Insurance attempts to help the family to get relieved of heavy financial burden. After the death of a breadwinner of the family is left with no or low income. During this period of dependency, life insurance funds provide regular source of income to the family. As such, insurance assists the family and provides adequate funds. It serves as a source of savings. We will see how. A man must plan to save regularly to provide for all the requirements. Life insurance plays a very important role to plan individuals' savings by investing in various insurance plans. Insurance schemes promote systematic savings in the form of regular premiums. The regular investment in the form of periodic payments of premium with high returns are available in insurance. High returns in the form of periodical bonus and maturity bonus provide with high return on one's investment in case the funds are invested in insurance policies. Then we will see importance of business. Insurance has been of tremendous use of the business society in many ways. Financial help. It provides financial assistance to business enterprise. The modern industry involves heavy capital investment in building, machinery, plant equipment, raw materials and acquisition of technical know-how. Insurance companies finance various capital projects in the form of equity participation and by granting loans and advances to the business enterprise. It reduces uncertainty of business loss. Business investments are exposed to loss or damage by fire, theft, accidents and other perils. So, the greater risks are involved in day-to-day functioning. The owner of the business enterprise, by acquiring an insurance policy, reduces uncertainty of business losses and be sure of his future earnings and smooth running of his business. It improves efficiency. Uncertainty about future is a handicap to economic progress associated with the uncertain future because of there are chances of losses due to various calamities. So, by taking an insurance policy, a businessman gets freedom from unnecessary worries and risks and can use more care and energy to maximize his earnings. Indemnification. Insurance ensures the compensation to the dependents of deceased employees and indemnifications of loss of damaged properties. The insurance enables the business to operate in the event of loss of properties and human lives as loss is finally indemnified. Grant of credit facilities. An entrepreneur can obtain credit by pledging the insurance policies as collateral securities for the loan. The business may take loan on the basis of insurance documents from the banks also. So far, fire and marine insurance policies are known as basis of getting credit. But now, besides these, life insurance and credit guarantee insurance have also become most important basis of guaranteeing credit to the business persons. But now besides these, life insurance and credit guarantee insurance have also become most important basis of granting credit to the business persons. Continuous of business, a damage to the buildings, plant and machinery not only cause material loss to the business, but also disturb the continuance of a business. So, there are chances of loss of profit and loss of assets. As such, insurable scheme make it possible to run the business uninterrupted and smoothly by giving compensation against these losses. Then employees security. Insurance provides adequate provisions for the grant of social security and welfare measures such as employees state insurance, life policies, old age pensions and accident policies for the benefit of employees. Due to these provisions, employees take more interest in the workings of the enterprise. Then we will see importance to commerce and industry. Insurance plays an important role to the industrial, agricultural and commercial development. It is very helpful for to increase the national productivity. Insurance covers almost all the risks relating to the agricultural, commerce and industry. For example, agriculture well experienced protection against losses of cattle, machines, crops, tools and equipment. In trade, there is risk in transit, godown, etc. and also in industry, there is risk of loss of goods, machinery, building, etc. So, insurance protects from these types of risks and such type of protection is helpful to increase production in agricultural, in industry, etc. So, these types of insurance plans provide stability to the industry and commerce. Secondly, insurance is a good source of earning foreign exchange as it covers export, import trade, shipping and banking services. So, risks in foreign trade can be minimized through insurance. Thirdly, insurance companies invest their surplus funds in bonds and securities of the companies which result into the development of commerce and industry. We can say insurance meets all the requirements of the economic growth of the country. Next, we will see importance to society as a whole. Insurance is useful to the society in many ways. Number one is protection to society's wealth. Insurance attempts to provide protection to living and non-living wealth of the society. Life insurance protects against financial losses. Loss of damage to property can also be indemnified by the property insurance. As such, property and life insurance are protections to stabilizes the business conditions and financial position. For economic growth of the country, insurance provides strong hand and sound mind protection against loss of property and capital to produce more wealth. Then it provides protection against losses. Welfare of employees creates a conducive atmosphere to works. Then standard of living. Insurance helps the number of persons who are rendered destitute through misfortune. They are able to maintain the standard of living due to high returns. They reduce the destitution and misery. They could lower the ideals and standards of conduct of entire communities. Then social security benefits. Insurance fulfill certain needs for which state might have to provide. The provision for old age, sickness and disability of persons in general. Some of who have their insurance do not become a burden on state insurance plan. Equitable distribution of losses. Insurance tends to distribute equitably the cost of accidental events. In the absence of insurance, this would have been paid in a haphazard manner. For example, the cost of fire insurance is reflected in house rent. In the absence of insurance, some tenants would pay higher rents than others. It will remove the social evils. All forms of insurance tend to reduce the extent of evils they are meant to elevate. The most effective argument for reduction of fire losses is that smaller losses will make smaller premiums possible. Accelerate the production cycle. Adequate capital from insurance companies accelerate the production cycle in the country. Economic growth of the country is not only assured, but the process of growth is accelerated, which is more essential in a country like India when the population is fast increasing. Reduction in inflation. How it works? Insurance reduces the inflationary pressure by extracting money in supply to the amount of premiums collected. It provides sufficient funds for production and narrow down the inflationary gap. Huge funds insurance accumulates from the small deposits of many persons, a large fund that may be invested and used in the development of industry and society. Huge funds are made available as capital, which otherwise would never be brought together in one place. The collection in form of premium from life, fire and marine insurance represent the contribution is insignificant indecently, but in total they amount to a gigantic amount. These sums are invested in the government and non-government enterprises to create assets for the benefit of the society. In this session, we discussed on origin and evaluation of insurance, kinds of insurance, principles of insurance and importance of insurance. Students, we came to the end part of Unit 1 Risk and Insurance. Shall we recap the Unit 1? As far as risk is concerned, we saw meaning of risk, characteristics of risk, causes of risk, comparison between risk and uncertainty, classification of risk and methods of treating risk. Regarding the insurance, we discussed on the meaning of insurance, definition of insurance, features of insurance, functions of insurance, origin and evolution of insurance, kinds of insurance, principles of insurance and importance of insurance. I want to insist that the concept of insurance again. Insurance is sharing the loss of few by many. With this, we conclude Unit 1. In the next session, we will move on to the Unit 2 Life Insurance. Take care. Have a good day.